Hello there, everyone, and welcome to our latest episode of the Market Misbehavior podcast. I'm your host, Dave Keller, the founder of Market Misbehavior, and it's so good to be joining you here today. And on every episode of the Market Misbehavior podcast, where we sit down with top market practitioners, investors, traders, strategists, money managers, authors, educators, anyone that we can put a microphone in front of to ask questions about the market environment, to unpack some of their thinking and their approach to analyzing current market conditions, their market outlook and how they're positioned and where they see potential opportunities going forward. Today we actually have a really fascinating guest, Michael Green. Michael is a PM and Chief Strategist at Simplify Asset Management. Mike's had a fantastic career in the financial industry. Worked at with some pretty great firms over the years. But what's most impressive when I first learned about Mike's work was years ago when he made a name for himself by promoting the dangers of passive investing and just the incredible flows that were going to passive products instead of active products, which were sort of the traditional mutual fund model. All of a sudden we have passive index funds and ETFs, which now become a lion's share of most retirement accounts. And he was one of the most vocal critics, or I guess not necessarily critics of that model, but critics of our inability to identify the challenges embedded in that model, some of the ripple effects that a lot of people were not appreciating, and how some of the traditional forms of analysis may not be as valuable because it's not about sentiment, it's not about active stock picking, it's about flows. And that's always been the case in some way, which is why I would argue technical analysis works. But Mike really pointed out some of the specific nuances that I think, or maybe some of the clear signals that are embedded in the fact that when everyone's in passive products, that creates a different structural environment. So we talked a lot about market structure in this interview. We talked about valuations and whether they matter in the new world of passive investing. We talked about the short-term versus the long-term impacts of passive investing, particularly in the year 2025, as we've seen this dramatic change from the great bull market of 2024 to the bear market phase of 2025. We talked about what an important change it was when investors, when employees were automatically opted in to their retirement plan and automatically opted in, for the most part, to something like a target date fund. All of a sudden, we have a lot of people not really, actively making a decision to put their money in certain vehicles. It's just automatically going there, probably in a way that a lot of employers are not really appreciating. We talked about the over-concentration of our equity benchmarks, the challenges that are faced for these markets when stocks like Nvidia and Microsoft and Amazon have a huge overweight in our benchmarks. And again, the flows into passive products were most meaningful. I asked Mike specifically how we can best detect the flows, and I thought some of the comments he made were really helpful, gave me some ideas that I jotted down about some next steps to further research some of the points that he was making. And he actually very generously shared a presentation of his own, just a slide showing one of the particular impacts that he wanted to highlight, which I thought was really cool. It was a chart I had not seen before. So it's actually a really interesting conversation, a lot more about market structure and about the importance of tracking flows. But I think after just a few moments of listening to Mike and understanding his background and why he's able to make draw these conclusions, I think you might be convinced, as I was. So please enjoy this conversation with Mike Green of Simplify Asset Management. So I'm super thankful to be sitting down today with Mike Green. Michael is from Simplify Asset Management. Mike, I've followed your work, and I'm aware of a lot of the work you've done, foundational work on active versus passive investing, which I'm excited to get to. We'll talk about the markets, but first off, thanks so much for coming on the show. Appreciate it very much.
David, it's a pleasure to be here. Thank you for having me.
So you're boldly coming on the Market Misbehavior podcast on Tariff Day, in Tariff Week, right? Sort of a lot of macro themes for investors to kind of get their head around. And certainly 2025 so far has proven dramatically different from the raging bull market, the great bull market of 2024. I mean, take a step back for us just to start off, as you're looking at the market. The S&P and the NASDAQ having 10+% drops from their peaks earlier this year. Do you generally find this market reasons to be optimistic, to be more cautious? What's your general approach given the uncertainty and given the volatility we've experienced here?
Yeah. So, well, first of all, I think it's always interesting that in the transition from the great bull market of 2024, 2023 to 2024, and into 2025, that we look at a 10% correction, we're like, oh my God, what is going to happen to the world, right? And the other thing that I would just highlight for people is it's not actually tariff day, it's ferret day, National Ferret Day. And as a result, I think that we can kind of take a reasonable guess that, no matter what else happens, it's going to be just a little bit stinky. The key thing that I keep trying to remind people is particularly equities are now dominated by an environment in which flows are the information, right? It's always been, the market has always been about flows. This is part of the reason why technical analysis has been able to stand against fundamental analysis. A fundamental analyst will look at the reports and talk to the customers and say, this is what's going to happen to cash flows. And a technical analyst will say, well, this is what's happening to the price, right? And what you're actually capturing in those transactions is that argument theoretically amongst the fundamental analysts. Do I think the cash flows are going to be better than other people expect? Do I think the cost of capital is going to be lower than other people expect? Therefore, my estimate of fair value is higher. A lot of that has gone away. And a lot of it has simply been replaced by, do you have a job? If you have a job, you contribute to your 401k. Your 401k buys a total market index. That total market index allocates that capital across market capitalization. And as a result, there's no real information content there other than I am employed. Right now, if you remove the information content from markets to largely focus it on the idea of am I employed, you move markets from leading indicators to lagging indicators. And I think this is one of the things that's so frustrating to people, particularly on the active side of the equation, because just like COVID, you could see the tariffs coming. You knew that this information was ahead of us. You knew that there was an economy that had been juiced on the basis of extraordinary deficit spending that is now suddenly potentially transitioning to not only different mechanisms of fundraising, but also attempts to rein in that fiscal stimulus. All else equal, that should be negative for the economy. And people can focus on that component. But the underlying reality is that we really have not yet seen a meaningful change in the number of people that are employed and contributing to their 401ks. And that flow dwarfs everything else that we end up seeing. Right now, there's tons of discretionary traders around this. There could be European investors that are pulling their money home. We saw very clear indications of that. We've seen very clear indications of systematic strategies like CTAs and trend followers that have reduced their exposure. But we really have seen almost no indication whatsoever that that flow coming from individuals who are employed into 401ks has retreated. And so every sell side shop is basically posting things saying, retail is buying as the professionals are selling. We don't actually know what that means in the context of the information, as much as we know that as long as that flow is there, it's difficult to get the market to really sell off. And so it raises risks that markets behave in a manner that is unlike what we have traditionally thought of, where we're thinking of the market as discounting information. And again, I always try to focus people back on COVID. Anyone who was paying any attention knew about COVID and the likely implications of it in December of 2019. By January of 2020, people across the street were positioning themselves bearishly, and the markets tried to sell off, and yet nobody had actually lost their job yet, right? And so, that month of February was this confusing, markets are rallying, pushing to all-time highs. What could it possibly mean? Maybe it's a good thing that we're going to kill off all the boomers and their inherited wealth is going to go on to their children, and their children are going to buy the most speculative stocks, right? Who knows what we were actually thinking at the time to justify the price action that we were seeing. But it literally wasn't until we started to shut the economy down and people started to lose their jobs and those flows came into question that we actually saw the sell-off. Unfortunately, I just think we have to be very prepared for something that looks very similar this time around.
There's so many things to unpack in there. And to be clear for all the listeners, I did not see this conversation ahead of time and ask you to comment on technical analysis. You offered that on your own. So thanks for that, because that's a core principle that we focus on, Mike. I appreciate your comments about combining those two disciplines in a meaningful way. Getting to your comments on flows and with passive investing, 100% understand what you're saying, that the markets can sort of just continue to go higher. A lot of people just sort of literally passively putting money into equities. What does it take for those passive investors to start to think more actively, right? I mean, theoretically, enough of them start to panic, start to rotate to money markets and bonds and other things. We really start to see things change. We arguably haven't seen enough of that yet. If we haven't seen it yet, like, what would it take? Is it just further deterioration to the point that your quarterly statement starts to really glow red and you start to be concerned? I mean, what would we need to see for that to change, you think?
So I've been quoted and have shared this freely that the scariest thing that I heard coming out of the pandemic, other than my mother reaching out and saying, perhaps I should move in with you, was a self-congratulatory message from Vanguard in April of 2020 that less than 1% of their clients tried to sell.
Wow.
Right. Now, my reaction to that is, oh my God, what if it had been 2 on one hand? And the other part is going directly to your question, like, what is it going to take to get them to change? And the simple reality is that since the advent of what's called the Qualified Default Investment Alternative, the QDIA, which was introduced with the 2006 Pension Protection Act, and really started to set the stage for a lot of the behaviors that we see, people are now defaulted into various strategies. And in many situations, they have no idea what they're actually invested in. They'll typically be allocated to something like a target date fund, and they will never stop to look at it or think about it. And that fear that you're describing, once they look at their quarterly balances, one, they're really not looking at their quarterly balances typically until they're much older. And if they do look and they're younger, the contributions that are coming from both their savings and their employer matchings basically make it look much more stable than it actually is, right? It's the Beardstown Lady effect from the 1980s, where they forgot to include their contributions in their return calculations. So it's very hard to get people to do this, which is why I actually just say, well, the answer is we take it away from them. One is there are mechanical components associated with these strategies that as people age, they will de-risk their portfolio, increasing the fixed income proportion and lowering the equity allocation. Do they do that because they're nervous? No, they simply do that because of the passage of time. And so there is a point at which these models start to begin to more heavily allocate to fixed income. And importantly, actually are continuously rebalancing. That was actually a key feature of what we saw in 2022. We can talk about that in some detail if you want. But if they lose their job or their employer cuts back on their contributions because of a deterioration in profitability, then all of a sudden the world looks like a somewhat different place. And we have to consider that, the most likely outcome of what is going to cause them to sit up and take notice is largely tied to outside events. It has nothing to do with the market. It has to do with what we're beginning to see, where there are record redemptions or loans being taken out against 401ks from people who have built up an asset base in their 401k and simultaneously built up a ton of credit card debt, right? Why would you be worried about retirement if you're going to go bankrupt on your credit card debt? You'll gladly pay the penalties associated with early access to your 401k for the very simple reason that going bankrupt in the future or retirement effectively is a theoretical concept. Going bankrupt today, losing access to credit, losing access to a car that allows me to drive to work, all of those things are very much real world phenomenons that can interject themselves. And in the process of doing that, you can cause stock prices to fall. You can cause spending to deteriorate. I think one of the most important things that's about to come out, this is just released by the New York Federal Reserve, that as student loans start coming back onto credit card onto reporting for credit bureaus, they have been stripped of that for roughly 5 years now. And it actually turns out that people have defaulted on their student loans at a remarkable pace. And so the New York Federal Reserve is actually projecting that something around 9 million borrowers could see a hit of as much as 150 to 175 points on their credit scores. That means you go from a potential borrower to you cannot access credit, right? That's how big that change is. And that sort of framework, I think, is unfortunately one that sits in front of us that then suggests those flows could deteriorate, et cetera. It also really depends on who loses their job. Right. No offense, David. I'm going to guess that you're roughly in the same age category as I am. So late hundreds. But the simple reality is if people in their 50s lose their jobs, those are the big savers. Right. Yeah. So, when we start talking about technological change like AI, when we start talking about a return to work environment in which workers have less negotiating power, it's those older workers that are often trapped in those situations. And we just got to watch that segment very, very carefully in terms of what happens to their flows. But I'll be honest with you, I'd be very surprised if a thoughtful elucidation of underlying economic outlooks drove any of the price action that we're going to see for a period of time.
It's so I mean, it's so absolutely true. And that book Nudge by Richard Thaler came to
Yep.
mind as you were talking about, where people all of a sudden opted into, 401ks, opted into a target date fund unless they do something most people don't think about it or want to think about it. And as a result, the ripple effects, sort of the side effects of that down the road are, I think we're sort of experiencing them real time as you.
We are absolutely experiencing them. And just very quickly, actually, the co-author of that book, Nudge, with Richard Thaler, is Cass Sunstein.
Yeah.
Cass Sunstein was actually the architect behind the opt-out framework of the 401k.
Aha, there we go. It comes full circle. Makes sense.
Yep.
That makes sense. So if flows are so important, and I 100% agree with what you're saying, I think understanding where assets are flowing and just the automated, the passive way that that's happening so vital. What's the preferred way to follow those flows? Because we could, I mean, in your opinion, because we can look at the charts, we can follow trends and just see what price action is telling us. We can look at fund flows, ETF flows, and more granular data. We can look at survey data. How do you actually measure what that impact might be?
So there's a couple of tools that are available, that are candidly quite expensive, right? So EFPR, for example, does a really good job of tracking flows into the ETF and mutual fund space. Cerulli and Associates and ICI have components around that as well. For retail investors looking to save money, I would encourage you to check out the ICI website. They have weekly historical flows associated with mutual funds and ETFs. That at least gives you a sense of the scale of some of the stuff that we're talking about. And helpfully, in many ways, they at least attempt to break it between active and passive, which can be an interesting exercise in some of these things. One of the key things to recognize is the definition of a passive investor is somebody who always holds every security. The actual literal definition does not include your ability to invest in a passive fund. The minute you choose to invest in a passive fund, you actually are an active investor who, instead of being passive, is instead choosing to be a systematic momentum investor. You are effectively buying stocks in proportion to their market capitalization. What happens when their price goes up? Their market capitalization rises. That means that the next dollar that you put in with your next paycheck is going to allocate more to stuff that's going up. This is one of the reasons why momentum strategies have been so dominant in this post-2006 environment, and particularly post-2012, when we actually changed that QDIA from a balanced fund, so something that was in both bonds and equities, to something that has basically specific allocations to individual areas and tends to allocate much more to equities, particularly for new job entrants. So these are all things that you need to kind of factor into the way you're thinking. Why is a momentum strategy dominant? Well, guess what? There are now 63 million households buying 401ks that are largely momentum investors.
Yeah.
Right. I don't care how good David Einhorn is or other really talented value investors. If you're standing up against 63 million, you're a little bit like Kevin Bacon in the movie Animal House. Remain calm. Right. Don't pay this much. Right. It doesn't work that way.
We'd include audio or video of that clip. It would probably have a copyright violation, but I appreciate Mike alluding to the great Animal House. Yeah, so Mike, so the challenge now to continue on that line of thinking is we have this over concentration in our benchmark, right? If it's all driven by flows, if there's a lot of passive investment fueling this momentum, we have top heavy benchmarks driven by a relatively small number of companies. That means in 2025, a lot of things actually holding up quite well. A lot of areas of the market actually doing okay, but a small number of big mega cap growth companies are down, and that really drags the benchmarks down. What does that over concentration mean, in your opinion, in terms of the current market environment and certainly the potential to recover going forward?
Yeah, so this is one of the more exciting things that's actually happened in the last couple of years in academic finance is an increasing recognition that the models or way we thought about markets, that they were highly elastic, that every buyer had a seller. And so, David, if you wanted to buy and I wanted to sell, that there would be very little impact of that transaction on the market. just to help orient people, the efficient market hypothesis, which underpins the ideas behind passive, assumes that markets are highly elastic. In other words, very capable of absorbing incoming flows with no real impact on price. This is elastic in the economic sense of changes in price tied to changes in supply and demand. In contrast, what we're now discovering is that the actual empirical data suggests that stocks are highly inelastic. And as a result, $1 into the market, instead of creating under an EMH type framework, basically 1 penny of market cap, because I'm a buyer, you're a seller, therefore the market cap shouldn't really change. The reality is what we now recognize is that it's all about how motivated the buyer is and how motivated the seller is. And so again, this is one of these areas where technical analysis is getting kind of an additional shot in the arm in terms of justification, because that's really kind of what you're looking for when you're looking for things like impulses or divergences, et cetera. You're effectively trying to identify where the intensity of selling or intensity of buying is starting to change in its underlying behavior. It turns out that that's a really valid way to approach the world. But when you introduce a passive framework, perversely, instead of flows affecting the smallest stocks, as you might expect, it turns out that they affect the largest stocks. And the reason why can be thought of in 2 frameworks. One is the sheer size of the dollar flow. So imagine you invest $1,000 into a Vanguard Total Market Index fund. How many dollars are going to buy Delta Airlines? About 0.002, right? How many dollars are going to buy Apple? About $70, right? Now, the relative market caps of Apple and Delta are not that extreme, right? Delta's approximately, I'm going to round this off, 100 times smaller than Apple in terms of market capitalization, but in terms of actual volume that is traded and the liquidity in the stock, it's only about 5 times, Apple's only about 5 times more liquid, right? And so if I try to put 100 times more capital to work versus 5 times more liquid, it perversely means I'm having a larger effect on the largest companies. The impulse of my buying is pushing them up more per dollar that I'm putting to work in them. Not only am I putting more dollars in, they're experiencing a higher multiplier. That's what this chart on the screen is trying to show here. This is market capitalization in log form. So 12.5, just to orient the reader, is about $3 trillion. The inelasticity can almost be thought of as a multiplier. So something that is, give or take, $50 million in market cap, the expected impact of me trying to put $1 to work is about $1 increase in market cap. Still a lot larger than what would be assumed into the EMH, but a relatively tame number. If I take that out to an NVIDIA, for example, the numbers that I'm getting now are $1 in creates about $150 of market cap, right? And so this incredible impulse is occurring, and it's not just because of the size of the order. There's also a substitution effect. Imagine I'm an index market maker, and I want to replicate the index because I'm trying to trade it efficiently. Or I'm Vanguard, and I'm statistically sampling my index as they do in the fixed income space. Do I really care whether I buy Delta Airlines at an immaterial portion of the index? Not so much. I don't even need it. It turns out that there's news coming out, and I'm just going to skip it today. We'll wait till the news to settle tomorrow. Or maybe I'll buy twice as much United Airlines as Delta Airlines, because really what I care about is exposure to the sector, not the individual name. And at the end of the day, who cares? It's Delta Airlines. It's 0.001% of the index, right? So I can choose to ignore it, and I'm not going to chase it. Can I create that index without buying Apple? No, right? I'd be exposing myself to extraordinary tracking risk. Can I create that index without buying NVIDIA or Microsoft, et cetera, right? So this lack of substitutability is another reason why we see this multiplier effect be so extreme. And so perversely, what this means is when the average investor thinks that they're buying a diversified index, what they're actually doing is creating an increasingly concentrated index that in turn flips that entire narrative on its head. We're just increasingly exposed to effectively a Mag 7 type world. And again, fascinating, there's actually academic literature that's come out in the last couple of years. This one's a paper by Zhang, who's at Michigan State, that highlights how this phenomenon, this rise of superstar firms, is actually a recursive effect that's feeding back on itself, creating wealth not only for investors, but also for the employees of those firms, the original investors in those firms. And is it actually telling us an economic signal about how wonderful these companies are that justifies why NVIDIA should be trading at 10 times sales? No, it's a mechanical output, right? So we've got sucked into this system, but it's totally mechanical in its underlying construction, and it's not really actually telling us any information. In other words, our policymakers are increasingly flying blind, as are many of our investors.
I was looking for some signs of optimism for our conversation, Mike. I don't know if I'm getting it necessarily from that last set of comments, but it makes perfect sense, and a really interesting way of illustrating how that problem kind of proliferates. Right, it just kind of keeps getting more and more exaggerated. So, I mean, given all of this backdrop, and given this over concentration, given the flows, et cetera, how do you position yourself as an asset manager? How do you position yourself as an investor in Q2 25 with the uncertainty that we're facing, with these sort of structural issues, I feel like, that don't seem to be going away? Where's the opportunity, right? Where do you look forward to in the months to come?
Well, I think this is really the critical component. It does boil down to effectively the macroeconomic forecasting. And again, perversely, there's academic research out that says, markets have become more macro efficient versus micro efficient. In other words, they don't tell us anything about the individual companies anymore. They increasingly tell us about the macro environment.
Yeah.
And that is the only thing I can really say at this point. Now, perversely, you as an individual investor, if you're participating in a 401k, there's an easy check to what that macro condition is. You just lost your job. Therefore, you're not buying the S&P 500. And guess what? A lot of other people probably aren't as well. That's your signal to sell. Right. So congratulations, you lost your job. You should sell. Right. On the flip side of that equation, though, unless we actually start to see that meaningful deterioration, and this has been my perverse feedback, right? I am the very first person to say I think the markets are fantastically overvalued, and I think that we are very much heading towards a potentially catastrophic resolution around these things. Right. You're not going to get any optimism from me on this. But the simple reality is, until those flows reverse, you got to basically invest like everybody else, and potentially even add leverage to it. Right. So seek out a higher beta expression of it. Now, all of this falls apart as soon as those flows reverse. We saw elements of that in 2022. And I just want to emphasize 2022 because I think it's probably the single best illustration of this new world. If you went back in 2022, what did you see? You saw the process reverse itself. The Mag 7 sold off more than you would have expected. Sure, there was a bunch of Cathie Wood garbage out there that never should have come anywhere close to it, and that fell even more. But the simple reality is that we were led lower by many of the largest stocks.
Yeah.
The reason why is actually really perverse, because if I'm running a target date fund, right? So imagine this is a systematically rebalanced portfolio that says how much equity should you own? It's a function of how old are you, right? Does that equity allocation change month to month? Not very much, right? I'm still basically the same age, right? And so I'm not going to change my allocation between bonds and equities. Doesn't matter what the coupon is on bonds. It actually doesn't. I'm going to have the same allocation regardless of whether interest rates are 0% or whether interest rates are 5%. So when Jay Powell shows up and hikes interest rates from 0% to 5%, bond prices, because they are cash instruments subject to arbitrage, have to fall in price. Right now, bond prices fall, and I'm running a balanced portfolio. Let's put it at 50-50 to make the math easy for people. What has happened? I'm now overweight equities, underweight bonds. So what do I have to do? I have to sell equities, buy bonds, right? That behavior is exactly what we saw in 2022 over and over and over again. And it was led by basically this process going in reverse. I'm overweight equities because bonds have fallen in price. Therefore, I need to sell equities, buy bonds. At any point in that calculation, did I do a forward-looking analysis of what cash flows look like or what interest rates impact on the weighted average cost of capital is? No. It's what's called the portfolio rebalance channel. Now, the question basically is, will we ever see people rebalance these portfolios? I think part of what we're actually seeing right now is the Europeans saying, yeah, we'll do it, right? You tell us we need to invest more in our own economies and countries. Okay, fine. We'll take the money from our investments in American equities. we will redirect more of our retirement flows into our countries. That hasn't changed yet, but it is coming. This is a form of financial repression that's on its way. So all of these things are basically suggesting that a turn is potentially right here at hand, that many of the flows that we've been accustomed to are in the process of switching. And therefore, that leads me to be very, very concerned and encourage people to look at things like fixed income, which are likely to see yields fall significantly if any of my economic forecasts are even remotely correct. But again, I just got to reemphasize, once people start to chase fixed income, what did we see happen in this last month? Fixed income rallied, equities fell. And as we came into the tail end of the month, everybody suddenly woke up and they're like, oh my gosh, I'm underinvested in equities. I'm overinvested in bonds. And the process played itself out in reverse to the consternation of everyone who was looking at tariff day as like, okay, this is going to be the clearing event. Markets, we've got our crash of 1987. Donald Trump is going to rethink his policy. It's not happening, man.
Mike, listen, I can't thank you enough for this conversation. This was super, super helpful. This is an area, I think, in terms of structural challenges in this market. It's an area that I think a lot of investors probably don't understand, underappreciate, and probably don't want to understand, because the reality is pretty significant in terms of its impact on the markets. But great reminder to dust off the 2022 playbook. Great reminder to follow the flows. And I can't thank you enough for helping our viewers come to that conclusion. Michael Green of Simplify Asset Management, I appreciate you joining the show so much.
Absolutely a pleasure. Thank you for having me, David.
It was a fascinating conversation. Again, I'm so thankful on the Market Misbehavior podcast I have the opportunity to sit down with smart, thoughtful people like Mike, who can really shed some light on market structural issues that I think a lot of investors are either unfamiliar with, or just maybe unwilling to really try to understand, because the conclusions can be kind of frustrating. It's worth noting we recorded this interview just before President Trump announced a series of tariffs the first week in April. So we did talk a little bit about an outlook based on tariffs, but Mike's comments came before that sort of initial shock to the market to the downside. But I think again, most of that conversation really still incredibly relevant, of course. And what was interesting is when I asked him about tariffs, I think if you noticed, which is a common theme with some of my guests, it's less about the short-term impact, which obviously can be severe, but it's more about the long-term. And I think his point about really thinking about flows over time, not one day, not 1 hour, but over time, thinking about the impact of flows over years, over decades, is where you really can understand the long-term trajectory of the equity markets and the long-term potential. And I swear, one of his first answers talked about the importance of technical analysis. We did not even talk about technical analysis before we started the interview. I was so thankful he went there and talked about the point of that, because I would argue, when you think about why charts work, I would argue it's because of two things. Number one, maybe three things. Number one, it tracks investor sentiment, right? And if you acknowledge the fact that investors are irrational, which I think you have to, if you've spent even a moment in the markets, that's pretty much a fair statement. Then charts are a great way of visually recognizing the changes in investor sentiment, right? Sentiment like fear and greed, euphoria, desperation. I think charts and price action are the best way to reflect that. But maybe the second one would be flows, right? I mean, I think if you want to understand where assets are flowing, when assets are flowing into a certain asset, the price kind of naturally appreciates because there's greater demand, whether it's active demand or passive demand. The market doesn't care, right? It's demand for a good, and so the price of the good goes higher. So I think the discussion with Michael was really interesting because it helped fill in some of the blanks that I had to round out my understanding about fund flows. I jotted down some potential data sources to dig into, hopefully things I can include in my own approach, my own analytical process as I try to gauge the trends based on flows in the months and years to come. Special thanks again to Michael Green of Simplify Asset Management for giving us some time and some really interesting perspective today. If you like the discussion we had today, particularly where we talked about the values of technical analysis, and if you want to learn more about how we can analyze price action to measure investor sentiment and fund flows, our Market Misbehavior Premium members may be a really good gift to yourself here in April of 2025 and for the months and years to come. 3 great benefits of the premium membership that we offer. Number one, All of our virtual courses, our main one's called Flight School Behavioral Investing, where we'll teach you all about behavioral biases, the bonehead mistakes we often make as investors, why we're hardwired to do them, and how we can use technical analysis to minimize the impact of behavioral biases. Also to improve our market awareness, what's happening around us as investors. I find a lot of times investors get into trouble not because they can't predict the future, but just because they don't have a good awareness of what's happening and what's changing in terms of market conditions. We'll teach you how to use all of those tools more effectively. Second, you have access to our members-only reports like our weekly flight plan. Every weekend, we look back at the week that just happened. What did we learn? What was new? What was different? We look forward at the week to come. What levels, patterns, signals are we on the lookout for? It has been a fantastic way of navigating these markets, I would argue, over the last 6 months, recognizing some key shifts, some leadership rotation, momentum shifts, all of those things. I think we're very clear on the charts, navigating this peak from 2024 to 2025. Also, our monthly chart review where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full access to our members-only community. It is a live, active, engaging, growing community of like-minded investors. You can ask questions at any point. I'm in there every morning answering questions from some of my premium members, and I would love to answer some of your questions as well. For more information on our premium membership, arguably an incredibly low-priced premium membership for the value that you get and the improvement in your decision-making and portfolio returns, you can go to marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months. So again, it's marketmisbehavior.com/premium and use the code PODCAST. That's it for today. Thanks so much for joining me. I'm Dave Keller with Market Misbehavior. Have a fantastic week. And remember, it's always a good time to own good charts.